My name is Michael Grandy. I'm a certified public accountant, and I'm a professor at Providence College teaching managerial accounting. We're going to have a presentation today. This is a PowerPoint presentation regarding Chapter 22 from our textbook, which is Kimmel 7th edition. And Chapter 22 talks about budgetary planning. There's a lot of material here. There's a great deal of budgets that are here. So again, as I've always mentioned in my classes, that the first step in the process is for you to read the textbook, get this material in your brain. Secondly, you want to view this PowerPoint presentation. Thirdly, you want to attempt the practice problems. And then fourthly, I would ask you to view the solutions presentations on my YouTube channel. And as always, in order to learn, in order to master this information, it's crucial for you to be constantly reviewing and studying this material. In addition to the 4 items I mentioned, you should be spending 20 minutes to 30 minutes a day reviewing managerial accounting. So let me start with this PowerPoint presentation. I'm going to share my screen, and we can begin this discussion. And I don't know if we're seeing that. Let me try this again. My apologies. Okay, so we're going to share that screen. There you go. And we're going to start this from the beginning. And I also want to duplicate this presentation. Okay, so we're looking at the PowerPoint presentation for budgetary planning, Chapter 22. And again, this is some intense information. It's not easy material. So let's jump in. Let's look at the learning objectives here. And the learning objectives, we're going to cover 1 through 4. The first learning objective is state the essentials of effective budgeting and the components of the master budget. Item 2, we're going to prepare budgets for the sales, production, and direct materials. Learning objective 3, we want to prepare budgets for direct labor, manufacturing overhead, and selling and administrative expenses, and a budgeted income statement. And then learning objective number 4, we're going to prepare the cash budget and a budgeted balance sheet. So learning objective 1, state the essentials of effective budgeting and the components of the master budget. What is a budget? A budget is a written statement of management's plans for a specified future time period expressed in financial terms. The primary method of communicating agreed upon objectives throughout the organization, promotes efficiency, and it's a control device because it's an important basis for performance evaluation once adopted. It is a plan for the future. Budgeting and accounting. Historical accounting data on revenues, costs, and expenses help in the formulation of a future budget. Accountants normally responsible for presenting management's budgeting goals in future terms, and budget in its administration are the responsibility of management. Here are some benefits of budgeting. Requires all level of management to plan ahead, provides definitive objectives for evaluating performance, creates an early warning system for potential problems, facilitates coordination of activities within the business, and results in greater management awareness of the entity's overall operations. It motivates personnel throughout the organization to meet these planned objectives. So here's a question. Which of the following is not a benefit of budgeting? Management can plan ahead. That's absolutely one of them. An early warning system? Absolutely. It enables disciplinary action to be taken at every level of responsibility. Absolutely not. The coordination of activities is facilitated. It's not a disciplinary tool. Essentials of effective budgeting depends on a sound organizational structure with authority and responsibility for all phases of operations clearly defined, based on research and analysis with realistic goals. So essentially, a budget is looking back at historical information and then taking current information and developing a plan for the future. What is the length of the budget period? May be prepared for any period of time, a year, monthly, quarterly. Different budgets may cover different periods of time. Base budget goals on past performance. We want to look at historical data, develop a budget with a framework of a sales forecast. And what we're going to see is, in order to prepare a budget, the very first question that needs to be answered is, how many units of our product do we think we're going to sell? Then we can build a budget. The budgeting process, factors that must be considered. What are the general economic conditions? What's going on in the industry? What does market research say about our product and our business and our industry? Anticipated advertising and promotion, price changes, and technological developments. Participative budget. Each level of management should be invited to participate and may inspire higher levels of performance. More accurate budget estimates, because lower level managers have more detailed knowledge. Overall goal, produce a fair and achievable budget while still meeting corporate goals. What are the disadvantages of everybody participating? Can be time consuming and costly. Can foster budgetary gaming through budgetary slack. So here are the flow of budget data under a participative budgeting. Again, starts from the bottom and works its way up. Each department prepares a budget and eventually going up to the president. Three basic differences: budgeting and long-range planning. Time period, emphasis, and amount of detail presented. The essentials of effective budgeting do not include top-down budgeting, management acceptance, research and analysis, sound organizational structure. Obviously, the last three are important. The first one, it's not top-down, it's bottom-up. Set of interrelated budgets that constitutes a plan of action for a specified time period. Contains two classes of budgets. Operating budgets result in the preparation of budgeted income statement, and financial budgets, which capital expenditures budget, cash budget, and budgeted balance sheets. So here is essentially all the budgets that you're going to be responsible for, components of the master budget. And you can see what they start with. The very first item they start with is the sales budget. Sales budget is going to be the core. It's the key. It answers the question, how many units of our product do we think we're going to sell? Once we know how many we're going to sell, then we can begin to put the pieces in place. So essentially, you're responsible for all of these budgets. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 budgets. Here's a question for you. Use this list to complete the sentences that follow. A blank shows potential sales to the industry and a company's expected share of such sales. It's going to be a sales forecast. Operating budgets are used as the basis for preparation of the budgeted income statement. Number 3, the blank is a set of interrelated budgets that constitutes a plan of action for a specified time period. That would be the master budget. And then number 4, blank identifies long-term goals selects strategies to achieve these goals, and develops policies and plans to implement strategies. That would be long-range planning. Number 5, lower level managers are more likely to perceive results as fair and achievable under a participative budget. And number 6, blank focus primarily on the cash resources needed to fund expected operations and planned capital expenditures. Those are going to be financial budgets. Learning objective 2, prepare budgets for sales, production, and direct materials. As I mentioned before, the sales budget is the very first budget to be prepared. It's derived from sales forecast and management's best estimate of sales revenue. Every other budget depends on the sales budget. It's prepared by multiplying expected unit sales volume for each product times anticipated selling price. In other words, quantity times price. Here's an example of a sales budget for the Hayes Company. The expected sales volume is 3,000 units in the first quarter with 500 unit increase in each of the succeeding quarters. That's the quantity. The price, the sales price is $60 per unit. So they're preparing an annual budget, in this case for the year 2020, and they're breaking it down on a quarterly basis. So you can see the projected sales by quarter and in total for the year by multiplying quantity times the sales price. The production budget shows the number of units that must be produced in order to meet the anticipated sales, derived from the sales budget plus the desired change in ending finished goods inventory. It's essential to have a realistic estimate of ending inventory. Let's put it this way. A company is going to make more than they expect to sell for a couple of reasons. Primarily because what if the demand for their product is greater than they expected? They never want to run out of their product because they'll have a dissatisfied customer. Now, what's important here is the formula you see here. In order to prepare the production budget, you first start with the budgeted sales in units, and you want to add the desired ending inventory. That is what you want to have on hand at the end of the month or the end of the quarter. And you also want to consider what you started the month with. What you start the month or the quarter with, that's the beginning finished goods inventory. And that is going to result in the number of units that you need to produce. The production budget. Hayes believes it can meet future sales needs with an ending inventory of 20% of the next quarter's budgeted sales volume. So you can see here, once again, they're preparing a production budget for the year 2020, and they're breaking it down on a quarterly basis. So the first item they start with is the sales budget, how many units they expect to sell. And in accordance with the formula we just looked at, they're going to add the desired ending inventory, which is 20% of the following month's budgeted sales. So for the first quarter, they have expected sales of 3,000 units, and they're going to add the desired ending inventory of 700 units, which is 20% of the following quarter's sales. $3,500 times 20% is 700 units. Going to add that in, and then they're going to subtract the beginning inventory, which again is 20% of the previous period. So in our case, it's the 3,000 units times 20% is 600 units. I'm going to subtract that. So you can see in the first quarter, even though they expect to sell 3,000 units, they are going to produce 3,100 units. And they follow that process through, pardon me, my phone's ringing. Sorry about that. They're going to produce 3,100 units. Direct materials budget. So now we know how many units they're going to produce. Now we need to be beginning to think about how much it's going to cost. And we need to think about all of the costs associated with that, product cost and non-product cost. The first element of product cost is materials. So the direct materials budget shows the quantity and cost of direct materials to be purchased. Units to be produced multiplied times the direct materials units per unit of unit produced equals the direct materials units required in production. So units to be produced multiplied times whatever quantity of the materials they need to purchase. And we'll see some examples. So the direct materials in units required for production, plus, again, we need to consider inventory because they always want to have some direct materials on hand. They don't want to run out because there might be some incidents of waste or mistakes that need to be accounted for. And if they run out of materials, then production comes to a halt. You then need to subtract the beginning inventory, and that'll tell you the amount of materials to be purchased. And we just saw that. Bottom line is important. Direct materials units to be purchased multiplied times the cost per materials gives us the cost of materials. So we first need to figure out how much we need to purchase, and then what is it going to cost? Again, quantity times price. Direct materials budget problem. Each unit produced requires 2 pounds of raw materials at a cost of $4 per pound. Throughout these budgets, we always need to be looking for quantity and price assumptions. Here is the first one. 2 pounds of material at $4 per pound. In addition, Hayes maintains an ending inventory of raw materials equal to 10% of the next quarter's production requirements. The desired ending direct materials amount is 1,020 pounds for the fourth quarter of 2020. Prepare the direct materials budget. You can see the first thing they start with is the units to be produced from the production budget. We then multiply that times the quantity assumption, which is 2 pounds per unit. They need 6,200 pounds for production, but we want to add the desired ending inventory, which is 10% of the following quarter's production needs. 10% of 7,200 is 720. You then need to subtract the beginning inventory, which comes from 10% of the 6,200 pounds, 6,200 pounds. So in this example, they need to purchase 6,300 pounds of material. The price assumption is $4 per pound. They're going to spend $25,200. And you do the same analysis for each of the quarters. Here's an example. Soriano Company is preparing its master budget for 2020. Relevant data pertaining to its sales, production, and direct materials budgets are as follows. Sales for the year are expected to total 1,200,000 units. Quarterly sales as a percentage of sales, 20%, 25%, 30%, and 25% respectively for each quarter of the 1.2 million. The sales price is expected to be $50 per unit for the first 3 quarters and $55 per unit beginning in the fourth quarter. Sales in the first quarter of 2021 are expected to be 10% higher than the budgeted sales for the first quarter 2020. Production. Management desires to maintain the ending finished goods inventory of 25% of the next quarter's budgeted sales volume. In direct materials, again, you're looking for quantity and price assumption as well as inventory levels. Each unit requires 3 pounds of raw materials at a cost of $5 per pound. Management desires to maintain raw materials inventories at 5% of the next quarter's production requirements. Assume the production requirements for the first quarter of 2021 are 810,000 pounds. So the first thing they need to do is calculate the sales budget. You can see total sales are 1,200,000, and they applied those percentages they gave you. And then the sales price per unit, which changes in the fourth quarter. There's your expected unit sales and your total sales. We then need to look at our production budget. How many units do we need to produce? And we start with the expected unit sales, and we add the desired ending inventory, which you can see is 25% of the following quarter's sales in units. 300,000 times 25% is 75,000. And then you need to subtract the beginning inventory, which of course is 25% of the 240,000 expected sales. And here are those footnotes that allow you to make those calculations. Let's look at the direct materials budget. Remember, there's three things going on here. You need to look for and remember the quantity and price assumptions, as well as the inventory levels. Units to be produced, that comes from the production budget. First quarter, 255,000 units. That's our first number in our direct materials budget. The quantity assumption is 3 pounds per unit. They need 765,000. And then we're going to do what? We're going to add the desired ending inventory, which is 5% of the following quarter's production needs. 945,000 multiplied times 5% is 47,250. We always add the desired ending inventory. But we also need to do what? Subtract the beginning inventory, which in this case is 5% of the quarter's production needs, which is 765,000 times 5% is 38,250. So in this case, they need to purchase 774,000 pounds of material. The price is $5 per pound. Learning objective number 3. Prepare budgets for direct labor, manufacturing overhead, and selling and administrative expenses, and a budgeted income statement. The direct labor budget shows both quantity of hours and the cost of direct labor necessary to meet production requirements. Critical in maintaining a labor force that can meet expected production. So the total direct labor cost formula is as follows. Units to be produced multiplied times the direct labor hours per unit, and then multiplied times the direct labor cost per unit. Quantity and price. Number of hours per unit, cost per hour. In our example, direct labor hours are determined from the production budget. At Hayes Company, 2 hours of direct labor are required to produce each unit of finished goods. The anticipated hourly rate is $10. So there's your quantity and price assumption, 2 hours per unit, $10 per hour. And we start with the number of units to be produced from the production budget. In the first quarter, they are going to produce 3,100 units. It takes 2 hours per unit, so they're going to need 6,200 hours. The labor rate is $10 an hour. It's going to cost $62,000 in the first quarter. And you repeat the process for each quarter. Manufacturing overhead shows expected manufacturing overhead costs for the budgeted period. And what's important to remember here, as you know, manufacturing overhead tends to be a mixed cost. So you're going to be looking for the formula. You're going to be looking for the variable cost per unit, and you're going to be looking for the fixed cost. In our example, Hayes Company expects the variable cost to fluctuate with production on the basis of the following rates per direct labor hour. Indirect materials, $1 per hour. Indirect labor, $1.40 per hour. Utilities, 40 cents per hour, and maintenance, 20 cents per hour. Thus, for the 6,200 direct labor hours from the direct labor budget to produce 3,100 units, budgeted indirect materials are $6,200. Budgeted indirect labor, $86.80. Hayes also recognizes that some of the maintenance is fixed. The amounts reported for fixed costs are assumed. So you can see the manufacturing overhead budget. It starts with the direct labor hours, and then you're going to multiply it to find the variable cost, which is a function of labor hours. So you can also see, although they break it all out, that essentially works out to be what? $1, $1.40, $1.80. It's what? $3 per hour, right? $1.40, $1.80, $3 per hour. So they break it out, but you could simply take the 6,200 hours, multiply it times $3 per hour to come up with the total variable cost of $18,600. And they went on to then tell you the givens for fixed costs, and you can see they are fixed. Even though the level of activity changes, those costs are fixed at $38,500 per quarter. So what's the formula to project manufacturing overhead? Mixed cost, total cost equals $3 per direct labor hour plus $38,500 per quarter. Selling and administrative expenses. It's a projection of anticipated operating expenses. And again, selling and administrative expenses tends to be a mixed cost, which includes both a variable and a fixed component. In our illustration, variable expense rates per unit of sales are sales commissions, $3, and freight out, $1. Variable expenses per quarter are based on unit sales from the sales budget. So the variable cost is a function of unit sales. Hayes expects sales in the first quarter to be 3,000 units. Fixed expenses are based on assumed data. Prepare the selling and administrative budget. So again, it looks like a lot here, but they simply broke it down. And again, it's a mixed cost. So in the first quarter, they got 3,000 units they expect to sell. And the variable cost are commissions at $3 per unit, $1 per unit for freight. But you can also quickly see it's $4 per unit. So the total variable cost is the number of units in the first quarter at 3,000 units multiplied times $4 per unit. It's $12,000. The fixed costs are enumerated there, but you can clearly see that they are the same numbers each quarter. That's they are a fixed cost, which amounts to $30,000 per quarter. The total cost is variable cost plus fixed cost equals total cost. In our example, the formula for selling and administrative expenses is $4 per unit sold plus $30,000 per quarter. Budgeted income statement. Important end product of the operating budgets. Indicates expected budgeted profitability of operations. Provides a basis for evaluating the company performance and prepared from the operating budgets. It's prepared from the sales budget, the direct materials budget, the direct labor budget, manufacturing overhead budget, and the selling and administrative budget, which we just prepared. The budgeted income statement is a computation of total cost per unit. To find the cost of goods sold, Hayes Company must first determine the total unit cost of producing one bicycle seat as shown. This is also a summary of the quantity and price standards, which we're going to see later, and the assumptions. Direct materials, quantity and price, 2 pounds per unit, $4 per pound. Direct labor assumption, 2 hours per unit, the labor rate is $10 per hour. And manufacturing overhead, well, you'd need to calculate the predetermined overhead rate, which works out to be $8. If we go back and look at that, you would take, here is our manufacturing overhead budget. If you were to take the formula, what is the predetermined overhead rate formula? It's the total estimated manufacturing overhead dollars divided by the activity base. In our example, the total estimated manufacturing overhead dollars is $246,400 divided by the activity base, which is direct labor hours. In this example, 30,800. You can see the predetermined overhead rate is $8 per direct labor hour. Let's go on to that standard cost card. And it's important to know right now, because you're going to see it later, that the predetermined overhead rate is the standard price, is the cost per unit for manufacturing overhead, which is $8. So in our example, the product cost per unit is budgeted to be $44 per unit. Where the company sells 15,000 units, the cost of goods sold is $660,000. So here is our budgeted income statement. And all of these numbers come from budget. The sales comes from the sales budget. If you remember, $900,000. We just calculated the cost of goods sold. The gross profit, selling and administrative budget gave us $180,000 of expenses. We have income before operations of $60,000, and they told us interest expense is $100,000 and income taxes $12,000. The budgeted net income is $47,900. Each of the following budgets is used in preparing the budgeted income statement except what? C, the capital expenditure budget. Another question. Soriano Company is preparing its budgeted income statement for 2020. Relevant data pertaining to its sales, production, and direct materials budgets can be found on the following slide. Soriano budgets 0.5 hours of direct labor per unit. Labor cost at $15 per unit, and and manufacturing overhead at $25 per direct labor hour. Its budgeted selling administration expenses for 2020 are $12 million. Calculate the budgeted total unit cost, and B, prepare the budgeted income statement. So here is their calculation of unit cost. Again, quantity times price. Here is their budgeted income statement when they sell 1,200,000 units. Again, this income statement is not prepared from journal entries and transactions. It's prepared with quantity and price assumptions. Learning objective number 4, the cash budget and budgeted balance sheet. The cash budget shows anticipated cash flows. Important output in preparing financial budgets. It contains 3 sections: cash receipts, cash disbursements, and financing, which means whether they need to borrow any money. It shows beginning and ending cash balances. This is the basic format of the cash budget. You have a beginning cash balance. You're going to start the year with some cash. You are then going to have cash collections from your customers. You then subtract off the cash disbursements, and you then figure out if you have excess cash or not enough cash. The financing section shows if you need to borrow money or you have the ability to repay money. The cash budget. Cash receipts section shows the expected receipts from the principal sources of revenue. expected interest, dividends, proceeds from plans, sales of investments, plant assets, and the company's capital stock. Cash disbursements shows the expected cash payments for materials, labor, overhead, and selling administrative expenses. And the financing section shows expected borrowings and repayments of borrowed funds plus any interest. Must prepare in a sequence. Start with the first quarter, go to the second quarter. Ending cash balance of one period is the beginning cash period for the next. Data obtained from other budgets are included, often prepared for the year on a monthly basis. Contributes to more effective cash management, answers the question, do they have enough cash when they need it to pay their bills? Here's another example. To prepare the cash budget, it is useful to prepare a schedule for collections from customers. This schedule is based on the following assumptions. So please know there's a difference between sales and cash collections. The sales occur based upon when the sale is earned. You've learned it in financial accounting when title transfers. However, that cash may not come in until a later date from your customer. So when will the cash be collected? We need an assumption. In our assumption, 60% of sales are collected in the quarter sold and 40% are collected in the following quarter. Further, accounts receivable of $60,000 at December 31st, 2019 are expected to be collected in full in the first quarter of 2020. Here's our cash collection budget. Let's look at the first quarter. The first quarter, they said they had an accounts receivable balance at 12/31/19. So in the first quarter of 2020, that $60,000 of accounts receivable is collected. You then have the collections from the first quarter sales, which is 60% of the current quarter sales, which is 108. And you can see second quarter, the 40% is collected. Remember, it's a 60-40 split. You do that for each quarter, you total it up. You can see in the first quarter, $168,000 of collections. Now, what about expected payments? Next, it is useful to prepare a schedule of expected cash payments for direct materials based on this second assumption. Direct materials, 50% are paid in the quarter purchased and 50% are paid in the following quarter. Accounts payable of $10,600 at December 31st, 2019 are expected to be paid in full in the first quarter of 2020. Again, this is a schedule of expected cash payments for direct materials. In the first quarter, they told you you had an accounts payable balance at December 31st, 2019 of $10,600, which is going to be paid, dispersed in the first quarter. And then the direct materials purchases are paid for 50-50. That is 50% in the quarter that they were incurred and 50% in the following quarter. And you do that for each quarter based on that chart. So in the first quarter, you have disbursements of $23,200. But there's some additional information that needs to go into this cash budget. The preparation of Hayes Company cash budget is based on the following additional assumptions. January 1, the cash balance, that is the beginning cash, is expected to be $38,000, and Hayes wishes to maintain a balance of at least $15,000. So what that means is they never want to go below 15, and they will borrow money to get there. Number 3, short-term investment securities are expected to be sold for $2,000 cash in the first quarter. So they're going to have a cash collection of $2,000. Item 5, direct labor is fully paid in the quarter in which it's incurred. Manufacturing overhead and selling administrative expenses, all items except depreciation are paid in the quarter incurred. Please know that depreciation expense is a non-cash expense and is not included in the cash budget. Number 6, management plans to purchase a truck in the second quarter for $10,000 cash. That's a disbursement. Number 7, Hayes makes equal quarterly payments of its estimated $12,000 annual income taxes. Item 8, loans are repaid in earliest quarter when there is sufficient cash. Remember, they never want to go below $15,000 in cash. So it looks a bit overwhelming, but all of this information has been provided to you. Let's look at the first quarter alone. The beginning cash, they gave that to us at $38,000. The collections from customers, that's the cash collections budget, is $168,000. They told us in the additional information they're going to sell an investment and receive $2,000. Beginning cash plus total receipts is total available cash at $208,000. And then you now have your disbursements, direct materials from the direct materials payment schedule, direct labor, manufacturing overhead, selling and administrative expenses were all provided to you from those particular budgets. They have the purchase of the truck, which occurs in the second quarter only. And they said they're going to pay their $12,000 annual income tax in quarterly payments of $3,000. So in the first quarter, they had available cash of $208,000. Total expected disbursements, $182,000. They have excess cash of $25,500, more than the $15,000 minimum, so they don't need to borrow any money. Now, what's important here, the ending cash balance in the first quarter goes to be what? The beginning balance in the second quarter. And you go through this whole process again. But as you can see in this example, for the second quarter, total available cash is $223,500. They have disbursements of $211,500. They only have excess cash of $12,000. They want to have a minimum of $15,000. So they need to borrow $3,000 to get there. You go through the whole process again for the third quarter. Now they have excess cash of $22,500, and they can do what? Repay the loan. They had borrowed $3,000, so they can repay that, plus the interest amount of $100, and they still have at least $15,000. What is the projected balance sheet? Projection of financial position at the end of the budget period. You remember what a balance sheet is. Statement of assets, liabilities, and equity at a moment in time. In this case, 12/31/20. So a lot of the information is developed from our preceding budgets, but you do need some additional information. Buildings and equipment, common stock, accumulated depreciation, and retained earnings. Cash ending balance was $37,900, shown from the cash budget. Accounts receivable, 40% of the fourth quarter sales, right? Remember, there was 60-40. Finished goods inventory, remember, they ended up with a desired ending inventory of 1,000 units, and the cost per unit was $44 per unit for $44,000. Raw materials inventory, buildings and equipment, accumulated depreciation. Accounts payable, 50% of the purchases. Common stock was unchanged. Retained earnings changed by the amount of net income. So here is the projected balance sheet. Again, not derived from journal entries and transactions, but from assumptions. So here's a question. Expected direct materials purchases in Reed Company are $70,000 in the first quarter, $90,000 in the second quarter. 40% of the purchases are paid in cash as incurred, and the balance is paid in the fourth quarter. Budgeted cash payments for purchases in the second quarter are $78,000. Right? Because what did I say? It said budgeted cash payments for purchases in the second quarter. And let's read it back again. Read company expected 70,000 in the first quarter, 90 in the second quarter. 40% of purchases are paid in cash as incurred, and the balance is paid in the following quarter, 78,000. Marsh and Company Management wants to maintain a minimum monthly cash balance of $15,000. At the beginning of March, the cash balance is $16,500. Expected cash receipts for March are $210,000, and cash disbursements are expected to be $220,000. How much cash, if any, must be borrowed to maintain the desired minimum monthly balance? So you're looking at the basic cash budget format, beginning cash plus receipts equals what's available. They then disperse $220,000. They have excess of $6,500, but they want to have a minimum of $15,000. So they need to borrow $8,500. So I don't want to cover learning objective 5. So that is essentially the material from this chapter. I strongly recommend that you look at the Hayes Company problem in the textbook to fill in the blanks. So thank you.